A quiet but momentous shift is underway in global finance. For decades, the US has enjoyed unrivaled financial power, with China as one of its biggest bankers, holding vast sums of US Treasury bonds. This arrangement was a cornerstone of the global economic order. But now, Beijing is methodically reducing its holdings of American debt. This is more than a financial move. It's a geopolitical statement with global implications. The US dollar's dominance has allowed Washington to fund deficits, project power, and wield sanctions. China's divestment challenges this paradigm, signaling that alternative systems are possible. The era of mutual economic benefit is giving way to intense competition. As of October 2025, the trend is undeniable and its momentum is growing. The implications touch everything from American mortgage rates to the balance of power in Asia. Is China simply diversifying, or is this a strategy to weaken the US from within? The answer is complex. What's certain, the world is watching. The decisions made in Beijing and Washington will determine whether the global financial system undergoes a managed transition or a chaotic rupture. The stakes are high, and the outcome will shape the future of international finance. The US-China relationship is being fundamentally recalibrated. The world's financial order is at a crossroads. To grasp today's crisis, we must look back at how this financial entanglement began. China's economic opening in the late 20th century turned it into the world's factory, amassing huge reserves in US dollars. The US Treasury market was the obvious, practical place to park this wealth. China's purchases of US bonds financed America's deficits and kept US interest rates low, fueling American consumption of Chinese goods. This cycle was mutually beneficial. America got cheap credit and goods. China got a reliable customer and a safe haven for its reserves. For nearly 2 decades, this financial symbiosis was seen as a stabilizing force. The peak came after the 2008 financial crisis, when China held over $1.3 trillion in US treasuries. This gave Beijing significant, if passive, leverage. The idea that China could dump these bonds and trigger a US debt crisis became a recurring theme, but was considered too destructive to use. Over time, this source of stability became a vulnerability for both nations. The US became dependent on a strategic rival. China risked exposure to inflation, currency swings, and US sanctions. The freezing of Russia's central bank assets in 2022 was a wake-up call for Beijing. It showed how powerful the dollar-based system could be as a tool of US foreign policy. This accelerated China's push to de-dollarize and reduce its exposure to US financial instruments. What began as a marriage of convenience is now a source of strategic anxiety. The era of chimerica is ending. The evidence of China's shift is in the data. From a peak of over $1.3 trillion, China's US Treasury holdings have dropped below $700 billion for the first time in over 15 years. This is a nearly 50% reduction, a staggering divestment. China's approach is deliberate, not panicked, selling gradually or letting bonds mature without reinvesting. Monthly data shows consistent net sales throughout 2024 and 2025. Chinese officials now openly stress the need to diversify reserves and reduce reliance on any single foreign currency. This is a clear signal. China is de-risking from American financial leverage. Some analysts believe China's true holdings are even lower, as it uses offshore custodians to mask the full extent. The message is unmistakable. China is retreating from the US debt market. The world is taking notice. The slow, steady march away from the dollar is real. China's reduced demand for US bonds puts upward pressure on American interest rates. The US Treasury must offer higher yields to attract new buyers, raising borrowing costs across the economy. The government will spend more on interest, crowding out spending on infrastructure, education, or defense. For Americans, this means higher rates for mortgages, car loans, and credit cards. Home buyers face steeper monthly payments. Small businesses see higher costs for expansion. This financial tightening slows economic growth. The Federal Reserve faces a dilemma. Market forces are pushing rates higher, limiting the Fed's ability to stimulate the economy during downturns. America's central bank has less room to maneuver. The psychological impact is also significant. The US Treasury market was once the ultimate risk-free asset. China's retreat introduces uncertainty, making other investors question the long-term safety of US debt. This could increase market volatility and the risk premium for US assets. The perception of safety is paramount in finance. Any erosion of that perception can have cascading effects. The consequences are not abstract. They're felt in every corner of the US economy. The era of easy money is ending. America must adapt to a new financial reality. China's bond sales are a geopolitical act, not just a financial one. By reducing its dependence on the US, Beijing gains strategic autonomy and blunts the power of US sanctions. This move signals to other nations, especially those wary of US influence, that alternatives to the dollar are possible. The BRICS bloc is already exploring new trade and finance mechanisms outside the dollar. China is also promoting the renminbi for international trade and developing a digital currency to bypass existing systems. The US faces a direct challenge to its financial leadership. The world is moving toward a multipolar financial order. China's actions could fragment the global financial system. For emerging markets, rising US rates make dollar debt harder to service and can trigger capital flight. Yet, a credible alternative to the dollar could give these nations more choices and reduce their vulnerability to US policy. Traditional US allies like Europe and Japan face a balancing act. Maintain ties with the US while adapting to China's growing influence. Europe is already discussing strategic autonomy and boosting the euro's global role. A less dominant dollar could mean less global coordination in crises. Competing blocs and currencies may make it harder to respond collectively to global challenges. The transition to a multipolar system could bring instability and risk. The current system, for all its flaws, provided a common framework. The new era will be more complex and uncertain. The world must prepare for a period of adjustment. The stakes are global. Experts agree a major shift is underway, but disagree on its speed and outcome. Some say the dollar remains unmatched in size, safety and liquidity. There's no real alternative yet. Others warn the dollar faces a death by 1,000 cuts, with China's actions part of a broader erosion. Technology could accelerate change. Digital currencies may create new payment systems outside US control. The decline of the British pound offers a historical parallel. Reserve currency transitions are slow, but real. America's debt and political divisions echo past empires in decline. China's bond sales reflect a larger transfer of economic weight from west to east. The future of the dollar is uncertain, but the challenge is undeniable. The US is not powerless, but its options are tough. The most important response is domestic: strengthen the economy, reduce debt, and restore political stability. Fiscal discipline and investment in innovation are key to defending the dollar's status. Internationally, the US must deepen financial ties with allies and make Western markets more attractive. Competing in financial technology, especially digital currencies, is now a strategic priority. America must shift from dominance to leadership, shaping the rules of a multipolar system. By engaging with emerging powers, the US can help manage the transition peacefully. The era of unquestioned US financial dominance may be ending, but American influence can endure. The choices made now will determine the nation's role in the new order. Adaptation, not nostalgia, is the path forward. We are witnessing a pivotal moment in financial history. China's retreat from US debt is accelerating a shift toward a multipolar world. The consequences will be felt in interest rates, currencies, and global power balances. The future is unwritten. America's reign is not guaranteed, nor is its collapse. The outcome depends on choices made by the US, China, and the world. This transition is fraught with risk, but also opportunity. The world your children inherit will be shaped by how we navigate these changes. The dawn of a new financial era is here. Are we ready?